Look, we're very optimistic. Clearly, it's been a terrific deal environment in Australia. If you look at our own performance, we've deployed roughly $1 billion of equity last year into three terrific companies. Peter's Ice Cream, the #1 ice cream business. SCA, which is a tissues and toilet paper business. Once again, great brands, #1 positions. And of course, Spotless, which is the #1 outsourced services company in Australia. And so we've seen really tremendous deal flow. Frankly, there were probably some other opportunities we would like to have taken as well, but just didn't have the resources to cope with that. Firstly, on the cost of capital thing, obviously we have a cost of capital made up of our equity thresholds plus the cost we're paying for the debt on a blended basis, and then there's an implicit cost in the equity markets as well. And so from time to time, cycles are such that those cross over, and it becomes a good time to take companies private. That's the most efficient deployment of the capital. But I'd actually point to the second thing, dissatisfaction, as being more important at the moment. We certainly saw this in Spotless. We certainly saw this in energy developments, where a schism had developed between the shareholders, their expectations and what they wanted to happen with the company, and their need for capital, and where management and the board were taking it. And so in those kind of circumstances where shareholders are looking for a solution, obviously private equity is a good solution. And I think the reason we've seen a number of those situations is that corporate performance in Australia has been okay, not great. And in a couple of pockets, companies have become heavily over-equitized on the back of deeply discounted rights issues following Lehman. Big promises were made by management, and those haven't been fulfilled. If you think what a carve-out is taking an individual business entity out of a system of overhead and support and making it stand on its own 2 feet and pursue its own strategic objectives. SCA is definitely a carve-out, and they're very attractive LBOs for obvious reasons. Often, releasing the potential in a company by allowing it to be free releases a lot of value. On the other hand, there's real risk there. Often management aren't well equipped to do that. You almost always need to invest additional cost into businesses which are subject to carve-out. And so, they're difficult transactions, but if you can get through the transaction and the cost impost that has to happen, there's often a great value creation opportunity. We don't fret about it too much, to tell the truth. Obviously, one of the luxuries of private equity is you choose when you exit. And so the only time it can be a problem is when a company is strategically ready for exit and it's running out of tricks and there's no opportunity to go out. And as we look across our portfolio, year-on-year profits are up high teens on average across all 10 portfolio companies. Most of them have a couple of tricks still to go. And so, whether it happens this year, next year, or the following year, doesn't matter too much to us. And so we can wait for IPO windows. In the meantime, there's plenty of other exits that we're seeing. Obviously, strategics have been important in Australia recently, both for us and for other folks as well. And increasingly, the secondary market in Australia is healthy. I don't know if it's become increasingly prevalent. My observation would be that those folks have been here for a very long time. I think you go back to the 80s and you see the first Hellman and Freeman LBO in Australia, and a range of those groups, probably 10 or 15 of them, have been coming and going ever since. And so, has their prevalence increased disproportionately recently? Perhaps, perhaps not. But we feel that that'll be an ever-present feature of the Australian marketplace. It's a terrific place to do business. People honor contracts, there's liquidity, and there's some terrific businesses.